let's look at Article 10, dividend. Now, first thing is, what is the meaning of dividend? While I'll get into the legal meaning in the next few slides, suppose there is a company, right? The company raises the fund through various means, including the funds it raises from shareholders, right? If the company makes profit, this profit is distributed to the shareholders by way of dividend, right? Now, the company would obviously pay corporate tax on its profit. Whether the shareholder who's made an investment into the company's share should also be taxed on dividend is something which is to be discussed here. And this is more specifically discussed in the context of the fact that if the company is a resident of one country and the shareholder is a resident of another country, how would that work is something what we are going to look at as a part of Article 10. In some cases, the local laws of the country, let's say if this company were to be in India, may provide that in addition to the corporate tax that is paid by the company, if the company declares dividend, it is not taxable in the hands of the shareholder, but the company itself should pay certain taxes. In India, like it is called the dividend distribution tax, right? The onus to pay this tax rests with the company and not the shareholder. And the reason for that is that in many cases, since the shareholders might be owning a smaller number of shares, it's very difficult for them, or for that matter, the tax authorities, to cover that tax. But then the question which comes up is, how would this dividend distribution tax be looked at in the country where this shareholder is a resident? Because of the fact that normally if the shareholder would have paid dividend in country X, right? If there is a tax liability on such dividend in country Y, he could have offsetted the tax paid in country X on dividend. Many treaties do not specifically address the issue as to whether this dividend distribution tax will be considered as a tax paid on dividend and eligible for credit in country Y. So in case of dividend, what happens is that there could be an investor who's a resident of one state. He makes an investment in an Indian company, which is also the source state, right? And this Indian company declares dividend to the investor. The questions which come up to our mind are, who should have the right to tax such dividend? Let's come to the issues. Should the right to tax be with the source state, right? Should it be with the state of residence, or both the source state and the resident state? What is covered by dividend, right? And which dividend should be taxed? Is it only the dividend paid which should be taxed, or the one which has been declared but remaining unpaid should be taxed as well? So the same question, whether dividend paid should be taxed, whether dividend declared and unpaid should be taxed, what is covered as dividend, how does the PE impact the taxation of dividend? We've discussed this earlier as well in several articles. We'll be discussing this in certain more articles that we'll be discussing. But the question here is that if there is a PE, which the investor that we looked at in the previous slide has in India, right? Does the impact of taxation of dividend changes? What about outbound investment? So in our previous example, we saw that an investor had put in money into the Indian company which declared dividend. What if the situation was reversed? The Indian company would have made the investment, okay, and it would have been the recipient of dividend rather than the payer of dividend. In that case, how would the taxation work? Outbound investments, right? So we'll look at these aspects in detail in the presentation.